Hi, I'm RJ Baxter with Fairway Independent Mortgage with your tip of the week. Hope you guys are having an awesome week. This week I wanted to talk specifically to the cash buyers out there. We have a record percentage of people paying cash for homes to be more competitive in this crazy market. So I wanted to talk about whether or not you can refinance right after buying a home for cash. And the short answer on that is yes. Yes, you can do a refinance to pull that cash out right after paying cash for a home. So a lot of people that we work with are being strategic this way, and they're coming in with cash from whatever source it is, and then just pulling the money right back out of the house to replenish their funds and essentially pay themselves back. So there's a couple nuances to think about when you're doing this that I want to point out to you. The first is that this is considered what's called a cash out refinance, which means you're going to be limited to 80% of the value of the home. And when you pull cash out this close to purchasing the home, the lender is going to use the lesser of the appraised value and the acquisition price. I'll say that again. The lender is going to use the lesser of the appraised value or the acquisition price. So if you purchase a property for, let's say, $600,000 and the property appraises for $650,000, the lender is going to use the acquisition price of $600,000 to calculate that 80% maximum loan amount, which in this case would be $480,000. Now, if you purchase the home for $600,000 and the home appraises for $550,000, they're going to use the $550,000 for the value on this cash out refinance. That's because of how recent this refinance was to when you acquired the property. So this is something to keep in mind. So if you're looking for a maximum loan to value loan, like a 5% down type deal, you can't do this on this type of financing. So that's the first thing to keep in mind. The second thing is that you can only replenish funds that were from your own funds. So you can't borrow from a family member and use those funds to pay cash for the property and then cash out right after closing and pay your family member back. You can only repay yourself. So like if you borrowed the funds from another investment or something like that, those funds you can pay back. So this is another very important thing. The term we use for this type of financing in the mortgage industry is called delayed financing, meaning that it's delayed till after the acquisition of the property. So those are just a couple of the nuances of this type of financing. This is something we commonly do, and it's something that can be very strategic in today's market, like I was saying, so that you can go in as a cash buyer, be more competitive, acquire that property, and then replenish your money after closing. So call me if you have any questions on this. Happy to answer your questions. Once again, my name is RJ Baxter. Have a great rest of your day, and thanks for watching.